See, in this chapter, we are going to see risk adjusted weighted average cost of capital. We have already seen companies are using weighted average cost of capital as a discount rate in project appraisal. When using WACC is appropriate as a discount rate in project appraisal, we have seen there are 3 points given. When the new project's risk is similar to the company's existing business operations, and second point is even after taking the new projects, company's debt equity ratio will not get altered, it will remain the same. Third point, the size of the project is small compared to the size of the company. In these cases, WACC, weighted average cost of capital, this existing weighted average cost of capital can be used in project appraisal for discounting and finding the present value. But business risk of the new project will be differing. It will not be same as the entity's existing business risk. So in that case, what to do? So when the risk of the, or you can say business risk of the new project differs from the entity's existing business risk, then we have to use risk adjusted weighted average cost of capital in project appraisal. So in order to calculate the risk adjusted weighted average cost of capital, we have to recalculate the cost of equity. So that when we calculate the cost of equity, recalculate the cost of equity in such a way that it reflects the business risk of the new project. We have done, like in your previous paper, financial management, you studied de-gearing. First you remove the financial risk and then re-gearing it. Okay, re-gearing, that is de-gearing and re-gearing, and then you use the beta, equity beta, which reflects new project's business risk and also the capital structure of the company, and that is used in the capital asset pricing model for calculating the KE. Okay, so same way, if the capital structure is expected to change after de-gearing, you will be using the new capital structure for re-gearing it. See, simplest way of incorporating change in capital structure is to recalculate WACC using new capital structure weightings. Okay, this is appropriate when the change in capital structure is not significant. Okay, yeah, so basically what they are saying is when the risk of the new project is different from the company's existing business risk, then we have to use risk adjusted weighted average cost of capital. Okay, that is one way. So first we will see how to calculate the risk adjusted weighted average cost of capital to use it in the project appraisals. See, risk adjusted weighted average cost of capital. Okay, same point. If the business risk of a new project is different from the business risk of the company's existing operations, company shareholders will expect a different return to compensate them for the new level of risk the company is taking. Okay, so how to calculate the risk adjusted weighted average cost of capital? See, first one, find appropriate equity beta from a suitable quoted company. They have to identify a proxy company and they can take the equity beta of the company in which is performing or having the project. Okay, there's new project into which the business is moving. The quoted company, or you can say proxy company, must be in that new line of business. Next one, we are adjusting that equity beta and converting into asset beta, which we call it as de-gearing. Next one, readjusting the asset beta to reflect the company's gearing level, that is re-gearing. Re-gearing, then using that equity beta in CAPM formula, we calculate cost of equity. Then after knowing cost of equity, we find weighted average cost of capital and then we evaluate the project. Okay, now we will see one question related to this, how to find risk adjusted weighted average cost of capital. Yeah, test your understanding. 1B PLC is a hot air balloon manufacturer whose equity debt ratio is 5:2. Company is considering a waterbed manufacturing project. B PLC will finance a project to maintain its existing capital structure. B PLC is a hot air balloon manufacturer. Debt equity ratio is 5:2. Okay, now they are moving into waterbed manufacturing project. SPLC is a waterbed manufacturing company. It has an equity beta of 1.59 and debt equity ratio is 2:1. The yield on BPLC's debt, which is assumed to be risk-free, is 11%. BPLC's equity beta is 1.1. Average return on the stock market is 16%. Tax rate is 30%. Calculate suitable cost of capital to apply to the project. Okay, first one, now they are moving into a new business, waterbed manufacturing. They already found a proxy company, waterbed manufacturing company, SPLC. Their equity beta is 1.59. Okay, so now what we will do, we will use this equity beta 1.59 and de-gear it in the ratio 2:1. Then we will be getting beta asset. That beta asset has to be re-geared using BPLC's debt equity ratio of 5:2. Then re-gearing will give you equity beta that will be used in CAPM formula to find cost of equity. After finding cost of equity, we know the cost of debt. Using cost of debt and cost of equity, we have to calculate the weighted average cost of capital, that is risk adjusted weighted average cost of capital. Okay, so we'll take the information from BPLC company. SPLC. SPLC is a proxy company. Okay, waterbed manufacturing company. 1.59 and 2:1 is the equity ratio. And BPLCs we will note down 5:2. SPLC and BPLC. Yeah, for SPLC, equity beta is 1.59 and the structure debt equity is debt equity. This is equity, this is debt, 2:1. For BPLC, the equity debt ratio is 5 is equity, 2 is debt. Okay, first one is de-gearing. Okay, asset beta equals value of equity by value of equity into 1D minus T into equity beta. Okay, so here equity SPLC, 2:1. So 2 by 2 plus 1 into 1 minus tax rate is 0.30, equity beta is 1.59. So you can solve this and get asset beta. So asset beta comes to 1.18. Next one is re-gearing. Okay, re-gearing is same formula. Asset beta equals VE by VD into 1 minus T into equity beta. Asset beta is 1.18. VE is this company's ratio should be taken 5:2. So this will be 5 by 5 plus 2 into 1 minus 0.3 into equity beta. So equity beta equals 1.51. Okay, now using CAPM formula, we have to calculate the cost of equity. Risk-free rate plus RM minus RF into equity beta. RM is market rate is 16 minus 11 into the one we calculated, 1.51. So KE comes to how much? 18.55%. Okay, next one. Cost of debt is already given. Okay. Cost of debt KD is risk-free rate, but you should take after tax, no? So into 1 minus 0.3. 0.7 into 11 will be 7.70 percentage. Okay, now we have to calculate the weighted average cost of capital in the ratio. This is debt, this is equity. Okay, so now WACC will be, see, cost of equity 18.55 into 5 plus cost of debt is 7.70 into 2 divided by 5 plus 2. Weighted average, this comes to 15.45 percentage. Okay, so now this can be used for the particular project, that waterbed manufacturing company. Okay, that they can use it. Yeah, next one, this is risk adjusted weighted average cost of capital. See, we have seen that when the new project's risk is different from the company's existing business operation, we have to use risk adjusted weighted average cost of capital. Okay, then another way is when the company's capital structure is expected to change significantly, we can use adjusted present value method of project appraisal. Okay, this adjusted present value, we call it as APV. Okay, adjusted present value method is used when company's capital structure is expected to change significantly. Okay, this approach, what we do in APV is we are separating the investment element of the, see, it separates the investment element of the decision from the financing element. That means you are taking what is the project cash flow from the business operation separately without considering the financial risk, and the financing impact of this project is taken separately. Then they are adding both the present values to calculate the APV. Okay, so APV is usually recommended, or we can use APV when the projects have significant financing component. We can use APV. See here, APV is generally recommended when there are complex funding arrangements. Maybe a business is undertaking a new project, the government is supporting by giving a loan at a very cheap interest rate or maybe at no interest rate, or the business is undertaking a project in another country. It is an overseas project where the government of the country is providing finance for the business at a very subsidized rate of interest. So in these cases and all, the financing component is significant. So we have to use APV. So APV we are separating. See, it separates the investment element of the decision from the financing element. Financing element, investment decision, both are separated. And we calculate. Okay, so first what we do here is we calculate the cash flows from the business operations and discount them at cost of equity of an ungeared form without considering the debts. Okay, assuming the company is fully financed by equity, so then only it is cost of equity of an ungeared form. Using KEU, we discount the cash flows from that particular business operation. This we call it as base case NPV. Okay, next one, the financing side of it, how the project is financed. The benefit from the financing side is calculated separately, and here we are using for discounting the cash flows either cost of capital, cost of debt or risk-free rate, KD. Cost of debt or risk-free rate is used to discount the cash flows or the tax benefits from the financing side, and we calculate that present value. Then we are adding both is base case NPV and cash flows from the financing side or the tax benefits because of the financing impact. Okay, that is taken. Both are added to calculate the APV. See here they are explaining. Adjusted present value technique. It evaluates the project and the impact of financing separately. That is a point in APV. Okay, so this can be used if a new project has a different financial risk from the company. The overall capital structure of the company changes. APV, value of a geared project, equals base case NPV. That is value of an equity financed project. There are no debts, only equity financed, means how the cash flows will be discounted. So here we are using KEU. Next one, financing impact. Present value of the financing side effects are taken and both are added to get the APV. Okay. This only we have to use. Sometimes the question that specifically mention calculate APV, then you can use APV. Even if not given, if you understand the financing impact is very significant in that particular project, then you can calculate APV, provided you should have all the necessary information to calculate APV. Okay. Yeah, first one, we have to find cost of equity in an ungeared firm. So what we do in order to calculate cost of equity of an ungeared firm, we find the beta asset. Beta asset means only business risk is taken into consideration. This beta asset will be used in CAPM formula to calculate cost of equity of an ungeared firm. This cost of equity will be used to calculate base case NPV. Okay, that is one step. Second one is financing impact. Okay, financing impact, generally I'll tell you what are the cash flows we will take. So suppose let us assume that they are issuing equity as well as debt to finance this particular project. There will be issue cost. For equity issue cost, there are no tax relief. It is only a negative cash flow. Whereas issue cost of a debt, there is a negative cash flow, and issue cost of a debt is tax deductible expense. So there is tax relief. So this is a benefit they are getting from the debt's issue cost, whatever tax relief, that is positive. Next one is as all financing. Okay, next one, interest payments will be made for the debts. There are tax reliefs on interest payments. Only tax relief on interest payment, not the interest payment. Okay, tax relief on interest payments. That will be again positive. Okay, this interest payments tax relief will come over the project's life. So we have to take the present value. Okay, wherever it is time value of money is there, you have to take the present value, and overall what is the amount, present value of the cash flows due to financing effect, that should be taken and added to base case NPV. Okay, when we discount the cash flows from the financing side, we can either use cost of debt or risk-free rate. You can put a note what rate you are using. Okay. Yeah, now we will see questions related to this APV, how to calculate APV. Yeah, grossing up is, there will be issue cost when they issue debts or equity. So we should take the gross amount inclusive of issue cost. Okay, so we'll see an example here. The finance required for a planned investment is 2 million net of issue cost. Issue cost are 3%, and the finance raised will also have to cover the issue cost. Finance reduced will also have to cover the issue cost. They want 2 million for the project as well as there is a 3% issue cost. That means this 2 million is without the issue cost. That means this is 97%. We have to calculate what is 100%. Okay. Divided by 97 into 100. 2,061,856 is the overall finance they need. 61,856 is the issue cost. Okay, so that is the point here. You cannot just take only 2 million because the company wants 2 million plus the issue cost. See here, 61,856 is the issue cost. Okay, so just to know how to calculate this, these are the examples. Next one, present value of debt issue cost. See here, for equity issue cost, these are not tax deductible, only the negative figure, whatever issue cost related to equity issues. Whereas debt issue cost is tax deductible. So we have to take the tax benefit from the issue cost of debts. See, issue cost at T0 is negative. Tax relief will be issue cost into tax rate, that is positive. Usually if there is time value of money, if the tax benefit comes after 1 year or 2 years, then you have to take the present value and take the net figure. Okay. See, issue cost minus present value of tax relief. Same way, interest payments are giving tax relief to the company. So the tax relief is the benefit. What is the present value of tax sheet? Okay, loan into interest rate into tax rate, only tax benefit on the interest payment. Okay, and this interest payment will be made over the life of the project or duration of the loan. So that many years they'll be getting the benefit. So you can use annuity factor to find the present value of the tax saving on interest payments. Okay, now we'll take the scenario, one scenario and do this illustration. See, $400,000 is to be borrowed for 3 years and repaid in equal installments. See, equal installments, 3 installments, 3 years. Risk-free rate is 10%. And all debt is assumed to be risk-free. Calculate present value of the tax relief on the debt interest if the corporation tax rate is 30%. Assume the tax is delayed 1 year. So 1 year later only they get the benefit. See, wherever the debts are repaid in equal installments, in order to know what is the annual installment amount, we have to divide the debt amount by the annuity factor for 3 years at the rate of whatever, risk-free rate, 10%. If you divide, you'll be getting the annual installment amount. Now we can prepare a table to know what is the interest payment every year. On that interest payment, the company, the project will be giving tax relief. Okay, we will do the calculations. Amount is 400,000, 10%, 3 years. Okay. Yeah, this is 3 years loan. $400,000 divided by 10%. 10% annuity factor for 3 years. Okay, how much it comes to? $2.487. $168.36. Okay, every installment. Next one is year 1 opening balance, interest at 10%. Opening balance 160. Yeah, opening balance 400,000. $10% interest is 40,000. Payment is 168.36 and closing balance is $279,164. Okay, closing balance. Second year is 279,164. 10% is 27,916 minus 168.36, 146,244. Third year, 10% is 14,624. Okay, 146,244 minus 14,624 plus No, plus 140, 146 244 plus 14 624 minus 160 836 comes to 32. 32 is the difference, no problem. You can even adjust it or leave it. So these are the interest payments. So on these interest payments, we will be getting 30% tax relief. Tax relief, and you can take the present value of the tax relief. Okay. So I'll work it out here. Interest is how much? 40,000 first year. Second 27,916. Third year is 14,624. Okay. What is 30%? 12,000 is a tax relief. Second year 8375, third year 4387. Okay, this we have to find the present value because tax is paid 1 year later. So this benefit is in 2, this is in 3, third year is in 4. So to find the present value, you can use 10%. 10% discounting factor means 0.826. Year 3 is 0.751, 0.683. Okay, present value 9912 6290 2932. Nine nine one two 6290 plus 2932, 19,134. Okay, so only this present value of the tax benefit from the interest payments will be taken for the financing side benefits. Okay, or you can say benefits of financing effect. Okay, so this is the idea. So we have to first find base case NPV. Next one, the issue cost of equity, issue cost of debt, and wherever there is tax relief is there, the tax relief, the benefits should be taken, present value of that, and then it will be added to the base case NPV, and the total amount is the adjusted present value. Okay, we will take one problem and do it. So we'll see it in the next video.